Hi, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by David Cervantes, Tracy Schuchart, and Adam Tumerkan. We're going to talk through some key things. We've seen a lot of drama this week. The first thing that David is going to walk us through is Fed cuts. Of course, we're going to talk about some of the stuff earlier this week as well, but David's calls on Fed cuts before the end of the year, really, really important. David has gotten all the big calls over the last 3-4 years bang on, so we're really lucky to have him here. Tracy's going to talk us through China's nuclear power plans and what's happening there. There's been a lot of focus on nuclear the last few years and a lot of kind of cheerleading and really China's making some big moves there. And when you talk through this, and then Adam is going to talk us through America's debt problem. Adam, I was telling these guys before the show, Adam is one of the most well-read guys I've seen about markets, economic history, and so on. And so I think Adam provides us some really interesting perspectives. And we're really lucky to have him on. So guys, thanks so much for taking the time. I know you're all extremely busy. David, let's start with Fed cuts. On Monday, we had, drama and a lot of panicked calls for emergency Fed cuts and 50 basis point cuts in September and so on. And, you kind of very humbly put out a note and said, hey, on July 9th, I said that, you should fade the July cut and focus on maybe a 50 basis point cut in September and so on with 100 before the end of the year. So you called no cut in July correctly. There were a few people out there saying it was going to happen. And then we had this, panic on Monday. So can you help us understand why you're looking for 50 in September and what's your thesis on 100 before the end of the year?
Yeah, so it really comes down to the labor market. The labor market is kind of the canary in the coal mine for the economy, and the reason that is even though it's lagging like most indicators are, we do have some pretty real-time data with the weekly claims data, and then secondly after that the non-farm and the U3 reports. But bottom line is the Fed has a dual mandate: inflation and full employment or maximum employment. In looking at the mandate, once the labor market starts to break, it's slowly then suddenly. So this is why you have things like the SOM rule, which is right now giving a false positive. But there's another empirical phenomena. Every time unemployment rises within by 1% within a 12-month period, a recession has always followed after that. And that's happened with every recession in the post-war period. So the labor market is kind of the tell on the economy, and it's a slowly then suddenly kind of a function. In other words, companies, as in an expansion phase, companies hire slowly. But once the writing is on the wall about a contraction, they are very quick to fire because they want to protect margins. And it's very easy to fire people across the board, boom. And that's why you have these kind of labor market dynamics where it's slowly then suddenly, because of firms' inclination to just shoot now, ask questions later kind of approach. So with unemployment ticking up since January, the U3 rate's been going up consistently since January. The idea is that we're kind of flirting with disaster here. So the Fed is really focused on the labor market. Obviously, they're a very inertial institution, meaning they kind of drag their feet and they're notoriously late to the trade. But I think there has been some institutional innovations where they no longer want to do that. And this is the best labor market in 40 years, in 2 generations, or one, depending on how you define it. But it is the best labor market that we have seen in a long time. And it would be a real tragedy, especially after the deficits that were run up to kind of promote the economy after the COVID. It would be a real disaster to let those labor market gains go. If they can keep the soft landing in check, this expansion can run for a long time, and it would be just kind of stupid to let it die here. So what they want to do, getting back to your question, why 50, is because lags. I think that before the old policy approach was we'll cut slowly 1, 2, and then we'll get more aggressive as need be. But that has always failed. And because of the dynamics of slowly, then suddenly on the labor market, they need to front run it. So they need to get in front of it, even though it hasn't happened. The momentum is there. The labor market's been weakening. We know this, and we know from prior cycles what happens. So front running is kind of their tactical approach to dealing with the strategic problem of keeping the labor market in check. So
Okay.
50, go big first is the point.
Okay. So, we've just had an Atlanta Fed GDP now number that was, raised. I think earlier this week it was raised by
today again. It was reiterated today, 2.9.
2.9. So we have an economy that is growing, at least at the GDP level. Maybe that's all government spending and jobs, who knows? But I'm just, it's very, it's a little bit strange to me. I mean, we've all been this kind of Fed twilight zone, Treasury twilight zone for the last few years, but it's a little bit weird to me to see us with a growing economy talking about rate cuts. So help me to reconcile that in my mind.
Sure. So one thing is GDP is revised for years. So you got to take GDP with a grain of salt. It's not a great real-time indicator. It's lagging and subject to crazy revisions. If you go back to every cycle, you see that we have these great GDP prints until, a quarter later, it's a recession. We go from expansion to contraction within a quarter suddenly, right? Everyone's shaking their head. But so now that we know this, we should not rely on it so much. It's kind of it's very noisy data. However, U3 is not really heavily revised. It's a pretty kind of a gold standard. So even though it is lagging and it's the last thing to go, it's pretty, the U3 rate is pretty spot on in terms of its reliability. And this is why we use U3 in every major policy discussion, whether it's the Taylor rule, whether it's the FOMC, the SEP, summary of economic projections. Everyone talks about U3. No one cares about non-farm payrolls. No one cares about GDP. It's all about U3, the labor market, and the output gap is a function of the labor market. And I don't want to get too much in the weeds about that, but U3, despite its shortcomings and flaws, is a better measure of what's to come versus GDP. Okay. So, yeah.
So I think, for all the, jabs that people take at the Fed, I think Chair Yellen has done a great job. I'm kidding when I say Chair Yellen. I think Powell's done a pretty good job actually managing the Fed's moves. Did he wait too late to raise rates? Yeah, I think people understand that, but when he did it, right? He didn't do 25 basis points. He really went in with guns blazing. So your view is that he's going to go out guns blazing as well, at least to start.
Correct. There's a symmetry. There's a symmetry in that, right? So they maybe dragged their feet a little too long, but once they decided to get off the horse, they went after it. And I think they will likely use the same template here, where you go big and you go hard in the beginning to signal the markets, and also to get in front of those time lags. It's better to just do that versus kind of dragging your feet slowly, then before you know it, you're super behind the curve.
Okay, so what about the pace of QT? Are they going to accelerate the pace of QT as they cut rates?
The answer is I'm not sure. I'm not really a QT follower, and the reason is QT is I view it as a residual. It's a tool, right? I think we need to look at their broader policy objectives and focus on that. QT is just a tool. It's just like rates are a tool. What you need to look at is understand the monetary stance, and you get that not from nominal interest rates, not from whatever. You get that from the spread or the gap between where the economy is and where they want to guide it. These are revealed preferences. So I like to focus on the revealed preferences and the stated motivations for where they want to get. QT, just a tool. Interest rates, just a tool. You'll
So
figure that out if you, yeah.
when you say they want to guide where the economy is, according to the Fed's world, by their definition, the economy is the rate of price changes and the levels of employment. That's it, right?
Sure.
So on Monday, when everyone says we need a 50 basis point cut immediately, the Fed's job, and I'm asking this somewhat sarcastically, but the Fed's job is not to manage the stock market, right? I mean,
Correct.
their definition of the economy is not GDP, it's price levels, or the rate of price changes, sorry, and the levels of employment.
Correct. Correct.
Okay. And so you're saying that you think, and sorry, so are you saying that you think that in Q3, we're going to start to see sharp job cuts across the economy?
So I think the risk of that is obviously rising. And I think the Fed, in not cutting in July and kind of kicking the can, and also not really, during this last, market spasm, not really saying a whole lot. I think with the Fed, they're also, look, they operate in a political environment, right? It's not a political vacuum, it's a political environment. And I think in letting, this kind of pullback in asset prices play out without doing a whole lot, it helps them with what they want to do. Because, imagine them, it's September, we're at all-time highs, blah, 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 everything was great. And they come out and say, we're going to cut 50. How do they justify that? It's also an election year. So how do they get in front of that? They get in front of that by letting things deteriorate a little more. So they have the cover of the political optics to cut in September. Now things are starting to look kind of scary. People are freaking out. And, this is a feature, not a bug. It's by design. It's how they get to where they want to get. By letting these asset prices pull back, by letting the labor market deteriorate just a little more, but hopefully not too much. And then they go in big and boom and save it. Yeah. That's their strategy right now.
Yeah. Adam, you had a question?
Yeah, with the economy, I really don't think the Fed, even if they cut, I really don't think it will really do much at all at this point, even if they cut 50, besides pump up some asset prices. I don't see firms just taking on massive investment or individuals getting reprieve from their insolvencies right now, or any of their missed, credit card average APRs are at the all-time high right now. It's what, 23%. I mean, that's eating away. And then Americans are carrying a record high nominal credit balance. Auto loans, same thing. I think what, 15% of households now are paying over $1,000 for an auto loan monthly payment. Like it's eating away at the disposable income. And I think we've seen that in the data. And I think that instead of the Fed doing anything, I think it's been more the fiscal deficit at this point. The fiscal deficit, we're still running at what, 50% below or above 2019 levels, and the government's spending so much, obviously, because someone else's income, and then they spend, become someone else's income, and so forth. So I just think as long as the government continues running these huge deficits, it's going to be hard for the Fed to even get inflation cooled down without demand completely plunging. And by the time that happens, we are starting to see that, and it's hurting China. Like, China's export-led growth is kind of falling apart now because US, like the recent data that came out, imports from China were down. And you get to a point where households only have so much capacity to spend. I mean, it's not like the public debt, right? Private debt cannot rise forever. It has to be paid back. And I was looking at some of the research on this, and to put it in perspective, between 2020 and 2024, consumer debt grew about 30%. But between 2010 and 2020, so a whole decade, it grew 28%. So basically the same with less than 40% at the time, essentially. Meanwhile, nominal wage growth has only grown 17% cumulatively since 2020 began. But as of between 2010 and 2020, it grew almost 30%. It was a huge, real increase. Meanwhile, the inflation was, grew, I think since 2020 to now, inflation's grown about 22%, just going off the CPI. no asset inflation, nothing else. And it took, in between 2010 and 2020, it only grew like 16%. So you had a huge increase in nominal wages in between 2010 and 2020. Yes, there was a lot of deleveraging going on post 2008. And it really, that debt only started really piling on after 2016, 2017 is when households started actually increasing net debt. But it's just, to me, like, I don't know how that's sustainable that can be long-term when you have debt rising much faster than nominal wage growth. Meanwhile, inflation is also much higher than nominal wage growth at this point, at least over the 4 years. So I really don't know what momentum households and the consumer have going forward, especially if the whole soft landing narrative at this point is basically banking on a strong labor market, but that's already kind of, and I agree the last report what may have been overblown because of that hurricane in Houston, so there could have been some skewing in the data, so forth. I've seen some things, but it is cooling regardless. And if you're seeing 2008 to 2011 high levels of credit card delinquencies and auto loan delinquencies, especially in the subprime area, at a time when the economy is supposed to be robust, I mean, good God, how's it going to look if unemployment falls off a cliff? So that's my.
So I think I'm sure what you're citing is absolutely correct and spot on data wise. I think the other side of that coin, though, is the asset side, and consumer balance sheets, or your household balance sheets, especially given the value of homes and the low level amount of leverage in the housing market, offsets that. There are trillions of dollars in locked up wealth. Right now, it's a little expensive to tap that equity wealth because of where the mortgage rates are. Again, I don't know the exactness of the numbers, but there's a record number of homes that don't have a mortgage where they're just owned free and clear. That is like literally piles of cash sitting there in the trillions. And then, the distribution of mortgages that for those that do have mortgages, 60% are under 4%. So, there's a very low cost of debt on the biggest asset that people have. So I would say that, the question you said was, I don't know what offsets that. And I think that is a very underappreciated part of the macroeconomy of, where home values, which is most people's biggest asset, are just, sky high values, low leverage. And I tell you, and usually when it's sky high values, it's like crazy leverage. But in this case, we have like a Goldilocks. Outside of the price affordability factor for new homes and building, it's a whole other story. But in terms of household wealth, we have a kind of Goldilocks Goldilocks mortgage household market with these very high values, very low levels of leverage, and very low levels of cost of debt. So I would say that is potentially something that would offset that.
Okay.
And I agree. Oh, sorry, Tony, do you mind?
No, go ahead. Go ahead, Adam. This is great.
And I agree. But then the question remains, and I agree with you, like no one's going to take out a HELOC if you're locked in at sub 3, who's going to take out a HELOC, what now, 10, 11%? So it wouldn't make sense to tap that equity. We are seeing them do it. The recent New York Fed report showed households took out, what, 300+ billion in HELOC. So I guess if they need the money, at least they can, they do have that equity built up in the home. But my only issue with that, or with the asset price inflation, which is a huge, obviously a boon for whoever's getting it or whoever has it, is it assumes that they're either going to sell their homes to tap that equity and downsize. And if you have more individuals selling homes to try to get out, that would push prices down at the margin for every home, right? If we have a block of homes and only 2 go for sale, that will set the price effectively for the whole street. So then you have a household who didn't want to sell, and he's like, wait, I'm underwater or something. Not that it would be underwater, but it's just at the margin. And then on the second situation is they would have to use HELOC to tap that equity, depending on that home price going higher. But if it doesn't go higher, then they just took out equity against their home. So I do agree with you. There is clearly a lot of equity in those who have homes. It's just I'd be worried that using that equity could have some ripple effects.
So I think this is a great one. I want to try to connect the dots, at least for me. Okay. So Adam, you're saying there's a lot more debt added to consumers. Inflation is accelerated. Wages haven't really kept up. David is saying there's a lot of wealth in homes. So if we see the Fed cut and that has an impact on mortgage rates, is the kind of the near-term result that a lot more people refinance their homes to take out equity to catch up on their debt to pay it off. I mean, is that a little bit of what the Fed is hoping for, in as much as it will get people out of these 3% loans so that they can pay off a little bit of debt to refinance and so on and so forth? Is that part of the plan?
I mean, I don't think the Fed really cares about anyone's balance sheet. That's not their mandate. They really don't care about that. I think that'll be a residual. What they want to do is, they do know obviously that the housing market is one of the most powerful transmission mechanism of rates. Okay, but what they really want to do, I think, aside from guiding the economy, keeping a soft landing, labor market, inflation, secondarily, with respect to the housing market, what they want to do is uninvert the curve. Because if you uninvert the curve, mortgage spreads are going to come in. Historically, they've been about 125, 150 above the 10-year, right? Now they're at 250, 280. And that's kind of a big anomaly. But that will kind of go away once they normalize policy and you have a normal yield curve. And that would really ignite. It would kind of be the Rosetta Stone that brings it all together. What does that mean? It means it stimulates the economy. It means it gets mortgage rates back down. It means it makes home equity a lot cheaper. And that all these problems, once that yield curve is normalized, all those problems just go away. They just take care of themselves.
So and with the yield curve, it's a bit difficult when the Treasury is just flooding short-term bills. Like Janet Yellen's been all about short-term bills, and obviously to get the duration risk off of the banks, you couldn't have them flooding longer-term debt, even though if it was cheaper, because it would have crushed the, any bank, SVB, anyone who held these damn bonds on the other end. But I'm skeptical. Are they trying to do this to, like, can the Fed really uninvert the curve if you're having the Treasury pour the supply of the short-term debt market, which increases the yield, which has kept it higher, and then they're gonna have to rotate eventually to keep it lower. But if they start refinancing at a longer-term rate, I would assume the Fed then would have to do some form of QE to suppress the longer end of the curve to absorb all that supply. So the U.S. fiscal deficit is kind of what's worrying me.
That's a complicated calculus that you're talking through, Adam.
So the yield curve is a policy choice. It's whatever they want it to be, not what the market wants it to be. It's whatever they want it to be. And right now, they've been issuing a lot of. I'm not really too much into the weeds about this because I don't really think it matters that much. I think the way they're managing the federal balance sheet, they're just waiting. From their eyes, it makes more sense to pay high bills for a couple of years versus locking in high yields on the long end for a lot of years. So I think a lot of the hysteria about, oh my God, they're doing this and this and this. It's like, no, they're just waiting for the curve to normalize. And then pretty soon you'll see that once the curve normalizes, they're going to, start issuing long-term debt, but at lower levels. In other words, imagine if in October of 2023, when they did the QRA and they said, oh my God, we're just going to dump all these tens. Guess what? Now they're locked in at 5% or 4.9. Well, guess what? Now rates are at 3.99 today. So they're just kind of just kicking the can on the short end just to wait to issue 10s and 30s or whatever at lower rates than what they were relative to the peak of the inflation cycle. So I think this is just, I don't take it as anything nefarious where they're trying to, I don't know, avoid the doom of the dollar crashing, the treasury market, and all this other stuff. I think it's just they're just being smart and kicking the can, waiting for time, and when the time is appropriate, they will issue tens. And
maybe that's way too rational of an answer.
Yeah, well, and I agree, but at the same time, like an inverted yield curve is the time to go longer debt. It's literally yielding lower than before, and they could have refinanced it lower. Even if it normalized, it wouldn't normalize that much higher on the long end. If the Fed cuts the short end, the long end is going down with it. But I agree with you. I'd read some good compelling papers that it's just because a lot of people use obviously bonds, rehypothecation, and so forth. They'll use it as an asset to leverage it out, that they couldn't risk the Treasury flooding a ton of longer term debt, which would have suppressed the bond prices on the long end, which could have led to another SVB, because if everyone had to sell at a huge loss, the what is it? Or they're still sitting on what, like 800 billion in unrealized losses, which don't matter as long as they don't have to get out of them. But you're right. I mean, I can't prove that, and who knows? But yeah, I was just trying to
Good.
play devil's advocate.
These are all great points, guys. These are all great points. David, okay, what do you say to the people who go, if the Fed cuts 50 basis points in September, that's going to impact the election, and the Fed is showing their political bias by helping out the current administration? What do you say to that?
Well, I think it's it's kind of not. It's one of these non-provable things. I don't know, maybe, but I think this is why they're letting things kind of get a little shaky first, so that they have that political cover I mentioned earlier. They don't want to be held to, they're going to hold themselves to a very, very high defensible standard, so that when Chairman Powell is at the back in the old days they called it Humphrey Hawkins. I don't know what they call it now, but I'm a dinosaur. So the congressional, when they do the political circus on Capitol Hill, they're going to ask him these questions, and he can rightly, correctly say, well, what do you want me to do? With the labor market's falling apart and we're on the precipice of a recession. Do you want to own that recession? Of course not. So I cut, and he's good to go. So I think that's part of the calculus. I mean, like I said, they operate. I think they're pretty non-political, but they do operate in a political environment,
Of course,
which kind of
everybody does.
Yeah, absolutely. So I think that's kind of the calculus of letting things get worse so that they can get the green light.
Okay, so David, one last thing. So I want to talk about your Fed cut thesis, but what is the biggest thing in markets that you're thinking about right now that we haven't talked about? Because I think we could talk to you for hours and learn a lot, but what's the big thing that you're thinking about that we haven't covered in this segment? So
I think, despite the talk of flirting with the recession, the labor market getting soft, blah blah blah, and kind of clouds on the horizon, I do think I'm very bullish this cycle in this economy, and I think the housing market, once these rates come down and the curve starts to uninvert, the housing market is going to ignite a massive growth cycle in the economy, even with rates falling. I think two opposing truths can coexist. You can have falling rates and an accelerating economy. So I think that's something that people should watch out for, is that I think we will get a growth bump in Q4, and there's no recession this year by a moonshot. I mean, obviously possible. People do make mistakes, meaning policymakers, if they hold on too long. But I'm very bullish the economy.
Great, very good, very interesting. Thank you so much. Let's move on to energy. Tracy, you were very quiet in that first segment, so I want to hear a lot from you.
Sorry. Okay.
No, it's okay. It's okay. Everybody wants to hear a lot from you. So you posted a piece on Twitter about China's nuclear plans. And we don't really talk nuclear much. There are kind of the nuclear kind of bros who talk a lot on socials and really try to pump it up. But this week, you posted this thing about nuclear in China. We've heard about nuclear for years in China, thorium reactors and all this stuff. They seem to kind of have a critical mass now. Of course, it's been building for years. China still uses an immense amount of coal, but their installed nuclear base is really intended to help supplement that and be kind of the incremental factor as they grow. I think there's still over 70% coal for electrical generation. I'm not exactly sure, so correct me if I'm wrong. So can you tell us more about where China places? I've got this chart up right now. China's, I think, second or third, approaching France. And what are the plans for nuclear in China? How rapidly can they grow?
Well, I think they're probably hitting the rapidity of what they're going to produce right now. And you also have to understand, I mean, this chart is based on number of reactors, not per capita energy source. So, which is a lot lower for China. So, if we look at the United States, perhaps, I mean, we're still we have one being built, 93 online. We're still the largest nuclear power generator in the world, actually, which most people, it seems, well, based on my responses, most people seem to not realize that, you know, the US still produces a lot of nuclear energy. Everybody thinks about France when they talk about
We
nuclear
think about
energy.
France, yep.
Right, they have 56 reactors, you know, per capita. It's, you know, it's higher than China, actually.
Mm.
So, but the United States is still at the forefront, and I think people overlook that. I think, I think, I don't think you're gonna see much more growth from China right now in nuclear, aside
okay.
from what is being built right now. Just because I think you're seeing kind of a downturn in their economy, kind of building these nuclear reactors is very expensive, coal is very cheap, uh, nat gas is very cheap, and things of that nature. So I think that just for the near term, and not uranium people, they're still building a lot. Don't worry, they're still gonna need a lot of uranium. I don't want the uranium people to come after me.
Right.
Hey, Tracy, I have a question. I was in Paris in May, and I have a lot of friends there. And my brother's an economist at the OECD, and the word there is that there's a shift in the winds in France, cutting back on nuclear, and they've actually been shutting some plants down. Is that your understanding as well, or is that kind of just talk on the street at a French cafe full of cigarettes?
I don't know. That's kind of a talk on the street. You have to realize that a lot of other countries import French nuclear power to particularly Germany because they rely on
Yeah, they've cut down a lot.
they shut theirs down.
Yeah. They're done.
So, you know, I don't think that, you know, I think France is still very pro nuclear. And there were some instances where they had some problems with some older facilities that they had to take down to repair and things of that nature over the last couple of years. But I think overall, I don't think France is abandoning nuclear energy by any stretch of the imagination.
Okay, thanks.
Hey, Tracy, weren't there issues also with like I know Italy imports, I think, a lot of nuclear energy from France also, and because of the Ukrainian-Russian war, that they were putting more pressure on France, like, hey, we need, you know, nuclear energy. And I was reading that a lot of the unions that worked at these plants, they were working like 70, 80 hours some weeks, and they needed to do some shutdown and maintenance on these nuclear reactors, but because of the pressure from the other EU countries, they couldn't turn them off, and it started upsetting the union workers. They're like, hey, we're working way too much. We need to fix these things. So I don't know if there's any truth to that or anything.
Yes, absolutely. We had a couple of strikes at a couple of nuclear plants in 2023. From what it seems, those issues have been taken care of at this point. We haven't seen anything in 2024. Again, you know, France has always maintained that they're going to be kind of the nuclear power of Europe. They've butted heads with Germany on this many times, but it looks like the labor issues, at least for this year, have been resolved so far. And so let's hope that. And again, they did end up shutting down nuclear capacity in 2023 for repairs, even though they didn't really want to, but you got to do what you got to do. And so I think those issues are kind of mainly behind them at this point. Not saying that it couldn't flare up again, but we have.
I don't know, Tracy. I don't know, Tracy. It's France. They're always having labor issues. They
Well, they
don't
are.
want to work. They don't want to work.
Thursday afternoon, time for a strike, right?
That's it.
So Tracy, it doesn't sound like your view is that there are going to be a lot more kind of reactors built in China. Go ahead. Sorry.
No. Finish your question.
Well,
yeah,
no.
I don't think we should all be depending on China for everything like we've always done. You know, what I want to see is nuclear build out in other countries. Like we've always depended on China. Is China going to be the growth factor for crude oil imports? Is China going to be the growth factor for nat gas imports, because Japan used to be, and that's kind of backed up. So, or is China going to be the growth factor for metals demand, or is it, I think we need to stop with China.
Hey, Tracy, do you think there's 2 or 3 countries that have massive populations that could benefit from nuclear? And do you know what the agenda is? For example, India, Brazil, maybe Indonesia. They have huge growing populations. They have the demand. They are at least India and Brazil are well, Brazil's somewhat politically not aligned, but India is pretty U.S. friendly, so we could share technology with them, and they're probably capable of doing their own anyway. Brazil, Indonesia, I don't know if Tony can speak better to that, if we're strategically comfortable with handing over nuclear technology to Indonesia. But what are your thoughts on at minimum India and Brazil getting more nuclear growth?
Yeah, so look, India right now has 19 reactors in functioning right now. They have 7 being built. I think that will increase. They're one of the large, aside from China, they have some of the largest increases in nuclear power. Brazil, we have 2 current reactors running and 1 under construction, though I can see that is a growth market, but they depend a lot upon their own oil and gas. So that's not, and I
What do you think?
I don't
Tony?
have
Do you think,
Indonesia off the top of my head right now.
what do you think, Tony, about the Indo? Do you Indo would be all right with Indo getting nuclear, or do they have it even? I don't know.
Nuclear is not an area of expertise for me, but there are a lot of earthquakes in Indonesia, so I don't really know. And I would think that Indonesia would rely on Japan for that nuclear stuff. Japan does a lot in Indonesia, Vietnam, other places. India would likely partner with Japan on nuclear technology because they have a pretty tight relationship. So, I know that Indonesia could use the power generation assets.
Yep.
I'm just not sure about, given the the earthquakes and other things there. I'm not sure how feasible it is there. Maybe it's entirely feasible, but I'm just not sure. But the point you raised about India is a great one, because India is going very hard after China's manufacturing.
Yep.
I think by 2040, all of Northeast Asia is going to be like 85 years old. So, Tracy's saying that, not really, but I mean, that's a little bit sarcastic, but Tracy's saying, expecting China to be the growth engine for fill in the blank always. This has been a generational opportunity, or a 2-generational opportunity that's going to end around 2040, something like that. China's workforce already peaked in, I think, 2015 or 2020 or something like that. So they're definitely on the downside. Nobody wants to have babies, all that stuff. So they're following the path of Japan, Korea, Taiwan on the demographic side. So, China will build these out. They'll last 50, 60, 70 years, hopefully. They'll have the power to get them through that demographic wave. And then they'll settle at some population point, generally with a slow growth. But the question, that I am wondering, I don't know if we know the answer to, is China, through like Shanghai Electric or some of those companies, are they exporting this to other places? Because I haven't heard much about like Belt and Road funding for nuclear power generation in other countries. Are they doing that much, Tracy?
No, not really.
Okay. Yeah, and I think, in fairness, I think China is really trying to innovate in nuclear technology, as far as I know. So maybe they're not ready to start exporting it because they're trying to innovate with thorium and all this other stuff. Again, I'm not an expert on nuclear, but I do know that China's done a lot to export power generation and other things through some of these companies like Shanghai Electric and stuff. But nuclear, it doesn't sound like that's a growth industry for them yet, like it has been for the French or the British or the Japanese or even the Americans.
Yeah.
And the Koreans.
It's just not what they're doing right now. Not to say that can't happen in the future. Certainly, something with Russia would not be under the realm of expectations, but at this point, that's not really a power that they're willing to export right now.
Right, and we haven't really talked about nuclear power generation in the Middle East. I think the Koreans built a nuclear plant in the UAE or something like that, or a few of them. And so that's, potentially, as the Saudis want they say they want to decarbonize, are they going to have more nuclear power generation in the GCC or something like that? Would that come from China? Would it come from Japan, France, whatever? Those are some really interesting questions that I'm sure someone knows the answer to. So if you guys know the answer,
I want to preface, I
comment.
am not a nuclear expert as well. I mean, it's.
But Tracy, you know a lot more than we do.
Yeah.
Under the
I-
umbrella of, what I cover.
Yeah, I guess my biggest question going into this was, how much more growth will we see in China? And what I'm
don't
hearing
think-
from you is not a huge amount.
I think we're pretty much capping that. Although, as we look at nuclear power in general, and I've been talking about this since 2020, most of that growth is coming from PAC Asia.
Mhm.
It just is.
Yeah.
Whether that be, South Korea or China or India, all that growth is coming from that region. It's just now in 2023, COP, that kind of nuclear was being talked about once again in the Western world.
Yep. Yeah. And then there's the other fact that we haven't talked about is German deindustrialization, partly on power prices and how they moved a lot of that to Chengdu or whatever. And, Chinese power prices are a lot cheaper than Germany. And it's just helped to kind of pull a lot of industry out of Germany and put it in China, right? So,
Wow.
so it
It
helped.
was like, sepulcher.
Yep.
what they did, but
Yeah.
it's what it is.
Yep. Okay, more to come there. So let's move on to America's debt problem, Adam, ever the optimist. You shared some things on Twitter earlier this week about that kind of bummed me out about credit card and auto loan delinquencies in the US. We hear all the time that the US consumer is unstoppable. We've got a few charts, so I'm going to put them out bit by bit, and if you can help us through these. So the first one looks at delinquencies over 90 days. And this is New York Fed data, and it goes back to, it looks like we're back at around 2011 levels or something like that with credit card delinquencies.
And an important distinction on that is that for anyone who can't see the chart right now, that was out of 2008. The 2011, the credit card delinquencies were falling. This time they're actually amplifying. So in 2011, it was high, but it was at least in a downtrend. Now it's in an uptrend going past the 2011 levels, just to give someone some context.
And this is a percentage of debt outstanding, and we have more debt outstanding compared to what we had in 2011, right?
Nominal wise, yeah.
Yeah.
I think real it just eclipsed it because I know the Fed does real and nominal debt, but I know nominal it's much higher.
Okay. David, you had a question?
No, he just, I was going to ask is it in absolute nominal figures or as a percentage of GDP or whatever?
Oh yeah, these are nominal.
Okay.
It's really interesting for me to see that red line, which is student loans from 2020, it just plummets to zero, right? And so is that because of the holiday, the payback holiday and all that stuff?
Oh, absolutely.
Okay.
Same with mortgages too. They gave them Morianas and everybody locked in at a sub. Oh, not everyone, but majority of people locked in at a sub 3%, and you had a huge boom in the equity, like David was saying earlier, which definitely helps their at least their home worth, preventing delinquencies on it.
Right. So it looks like we've seen delinquencies of credit cards rising pretty well from say mid 2023. So what does that tell you? I mean, I don't mean this to sound like an ignorant question, but what is this chart specifically telling you?
Well, I think we need so how debt works, debt is buying power, right? I mean, it is demand. We're not in like a cash society anymore. You can't go to a bank and be like, or you could, but I believe 86% of all cars now are financed, or at least new cars, they're financed. So that tells us two things. If I went to a car company and I said, hey, I have 15 grand cash, I want to buy this car. And they're like, well, we're charging 30 grand. They either have to lower the price to make that sale to me at 15 grand off, so 50% off, just for me to give them my cash, or I have to make more money, but they probably don't want that because that'll take years, right? So what's the other solution? Hey man, we'll finance you. Take out a loan. That's new money. So you just create that 15 grand out of new, thin air. You go, you get the money. Now you get the car. They get the deposit, that extra 15 grand plus your 15, so 30. They move the inventory. They look good on their balance sheet because they made a sale. I get my new car. Bank's happy. They get, a cut of the interest, or most of these companies will finance these things themselves now, like Ford Credit. They essentially just will give you the money to buy their own cars at this point.
And buy now, pay later is the extreme example of that, right?
Yeah, and then buy now, pay later just doesn't show up on credit scores, or there's usually sometimes not really interest on them. There will be if you miss payments. There's some issues with it. But in my opinion, these are all just schemes to get more inventory out the door. Like, you literally need debt or some kind of buy now, pay later. Because if you're a producer, look at the auto sector the last week. Did you see Nissan's operating margins plunged 99%? Stellantis was down 50%. I mean, they got wrecked. And now they're all Stellantis is doing some of the biggest discounts. I think auto dealerships still can't even get rid of 50% of the 2023 Stellantis models. Nissan too. Now they're getting crushed out by the BYD in China, Japan, and European market now is 11% BYD. It was 0 4 years ago. So there's too much supply. They can't move the inventory. It's cutting. So they're having to cut these prices, especially when auto loans are so high. No one's taking out an auto loan as much. I mean, there are some, but then the problem is when you're doing these discounts, you're cutting prices. It kind of goes back to what you were saying about the debt thing, is that households are either shying away from more debt at this point. They're not taking out as much. Consumer credit change, it's still up, but it's receding definitely in year-over-year terms compared to last year. If you look at credit, auto loans are negative growth from commercial banks right now. They're just, and it kind of ties into this why we're seeing used car prices fall, right? If there's no new debt being taken out to fuel the demand, the prices got to come down to move the inventory. You got to get rid of the sales. Now, Stellantis is going to lay off employees. They're doing that now. Ford is talking about laying off some employees. Tesla's been laying off some employees. Because what do you do if your margins get crushed at this point? You got to cut costs somewhere. And that's kind of what worries me, is that there's too much debt, or that these interest rates, the Fed did a good piece recently on credit card utilization rates. They're extremely high, and then the delinquencies on these are also very high. I think FICO credit scores had their first downturn recently for the first time in like 11 years. Granted, it only fell by like a point, so it's not, not crazy, obviously, and it's gone up significantly since 2010. But a lot of them went up post 2020, and there's been some good research coming out saying, was this like a phantom credit score rise because households who were getting a lot of stimulus from the government, it cleaned their balance sheets up artificially. Now they're having to go back to it organically. Are they really a 720 at this point? And it's like, well, clearly some of them now aren't, and now banks are talking about it. Bank earnings last quarter, I'm sure you saw, like NYCB, a lot of them, Capital One, they had bigger loss provisions for debt defaults or debt delinquencies, money they're assuming they're not going to get back at this point. So I don't know. I think that becomes a problem, especially when you have an economy so hooked on debt. If debt growth is slowing, or you're just hitting a point where debt growth cannot keep growing, where is the demand going to come from? And then it will depend, like always, on productivity to increase nominal wages. Well, productivity has been fading for 40 years. If you look at the growth of it, it's just been declining. Less labor output per hour. U.S. manufacturing productivity has been literally flat for 2008.
Yeah, let's get into productivity in a little bit. I think that's one of the charts that you have. One of the things I want to let you guys know about is this, and maybe you all know about this, maybe I'm the last person to hear about this, but this is what I learned this week. Payroll companies are going to start allowing employees to go in and borrow against their pay. Okay. So the BNPL stuff, the buy now, pay later stuff, is going upstream all the way to payroll companies because they want to get in on that interest game. So it's basically payday loans offered directly by payroll companies, which is, I think, truly dangerous, but it's probably going to be mainstream within about 6 months or something, right? So, David, what do you think about that?
Well, I actually think that's a good thing. You know why? That market already exists. You go to any working class or lower neighborhood, that market's already there. What they're going to do is clean that market up. They're going to institutionalize it, and the loan shark easy money of 40% annualized or even higher. I don't know. I've never taken a loan out like that, but those loans are not cheap. These are double, triple digit type,
Yep.
mafia type numbers. So what you're going to see is, that's already, my point is, this is nothing new. It's already happening. They're just going
It
to
is
clean up that
happening
business.
in the informal economy, right?
Correct. And then all that's going to happen is it's those spreads, that lard in those, double, triple digit payday loans annualized is going to compress. And you'll probably have higher legal standards, better disclosure standards. Right now that's a very, that's a very borderline black market type economy. If it gets mainstreamed, the question is not, does it get, mainstreamed or not? It's a question of, does it grow once it's mainstreamed? So it's kind of like the old, it's kind of like the old, do we legalize pot or not? We're already doing it. It's kind of the same argument, right? These things, do you legalize prostitution? Do you legalize all this other stuff that we know happens?
Yeah.
But we kind of turn the other way. So I actually think that's, there could be some social benefits from this.
Sure. Yeah, that's fair. That's fair. Okay, let's move on to your second chart, Adam. So you can you also walk us through the impact of paying down debt? Now, you already mentioned that debt is, of course, it's consumption pulled forward. So I think you covered a little bit of this, but can you talk us through a little bit of what your main point is here in terms of the complications of paying down these high levels of debt?
So yeah, so anytime you deleverage, which is for anyone who doesn't, that means pay down debt. It's, how I would put this is, there's a term called the fallacy of composition. So if you look at one household, a friend in the family, and you're like, hey, you have a lot of debt outstanding. You need to start paying it down. And they go, man, you're right. I'm gonna stop spending my money because I only make so much fixed disposable income. I'm gonna stop spending. I'm gonna start saving, and I'm gonna start paying down the debt I owe. Everyone will applaud this guy. Be like, that's moral, right? That's a good human right there paying his debt down. Well, this is where the fallacy of composition kicks in. You get an entire state doing that, it will bring down the entire economy. And you could look at Japan, look at China today, look at the US in 2008, look at Euro post 2011, Great Depression. The moral good thing to do, paying down debt, becomes a problem with everyone is doing it, because everyone now is actually deleveraging, selling assets, or not spending, saving money. You can only do two things with the same dollar. If you're saving, you're not spending. You could, it's one or the other. You're either taking on debt to spend, or you're paying down debt by not spending, since you're using that money to pay down the debt. So my worry now is that as households are reaching these balance sheets, or delinquencies are rising, maybe banks will tighten more credit, or just households will eventually have to pay this back. There's two implications. Either wages are going to rise significantly in the next few years that'll justify them to pay all this back, or they're going to have to start selling assets. Problem is, if you start selling the assets, that'll bring down asset prices, right? If you're having too many people sell, because if everyone's selling, they're not buying it,
well,
that
consumption has already worked into the economy, right?
And it's already worked into the economy. So now if you're Ford and you're like, cool, we made a lot of sales last year, what about this year? Oh, get them hooked more on credit, like more credit, easier, longer term loans, lower interest rate. More housing companies, they're doing mortgage buy downs of like, what, I think you can get 4 or 5 right now. You need to move the inventory. That's the thing. No one's showing up like, hey, I got 380 grand cash for this little tiny home, blah, 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 but I can't get I'm not going to get a 7% interest rate. They're like, what, honestly, just to get this damn thing sold at this point, we'll just do the buy down and take care of it later.
Well, that's compounded with disinflation, right? So people deleveraging and disinflation at the same time, it puts serious pressure on margins. So I think what you're saying about wages is very important for people to understand. Unless we have wage rises, it puts a real damper on consumption. And is this an absolute going to happen thing? No, but it's a real risk that I think a lot of people aren't necessarily looking at. So in terms of wage rises, let's look at productivity. So you talk about productivity, and we've heard about AI for the last 5 years or whatever. And we've heard that AI is supposed to make us more productive, but it's not showing in the productivity data. So if AI were supposed to make us all that productive over the last 5 years, we would have all been able to pay off our debts. But we haven't, to be honest. I run an AI company. I don't think people are really to the point where they're adopting AI to be more productive yet. They're adopting it as a cool, shiny thing. They're not adopting it for productivity. So that has yet to come, and that typically only comes in the technology cycle when people have to adopt it. So when there are layoffs and you have to substitute people for tech, right? So we're not there yet. We'll be there in a year or 2 years, I think. But what has happened, Adam, in previous productivity cycles? If we look at, say, the 90s, was it really tech that contributed to productivity, or is that just kind of some fable that we've grown up with?
So there's a good book about this I recommend everyone read. It's by Robert J. Gordon, a big tome. It's kind of a brick, but it's called The Rise and Fall of American Growth. And he goes back since the first industrial revolution. And he looks at waves of growth. And he said the second industrial revolution, which was essentially known as the Great Century, which was about 1870 to 1970, was a phenomenal, it touched every aspect of the standard of living, right? I mean, the first industrial revolution, you had the train, the cotton gin, textile mill. So you had things that were the cable line that you can Morse code. And they were big, but they didn't really affect the standard of living of every single person. Yeah, 1870 to 1970, you had the mass food consumption. Canned goods, right? Mass consumer, they could get canned foods. They built out the roads, the auto vehicle, music, the radio, AC units was a huge one in the 1960s because now you could have people out west. They had the airplane, like it literally increased the living standards and the productivity through the roof. The problem is since the 1970s, and he goes into this in the book, besides the infotech sector and the biopharmaceutical sector, it's essentially been flat. Like there has not been any big oomph. Like, yeah, cars get nicer, but now it's like you're buying a car just for like, oh, there's a nicer airbag. Oh, it goes a little faster. But that main productivity boom that increased from giving like someone working in a rice paddy field, give them a truck, their productivity will go through the roof. Give FedEx a little fancier truck today or an eco-friendly truck, that's not going to give them an increase in productivity, right? We can pave the road. It's not going to stop Amazon from being like, oh, like an extra bump blew a tire out after what, 30,000 miles. So like the productivity, the cost savings aren't really there. And that's his argument. Is he was saying that even in the age of AI in this era, what is going to be the huge productivity impact? There's nothing really new coming in. Besides to make things, or how he said it was, there's nothing revolutionary now, it's just evolutionary. So things are just getting more compact, cleaner, easier. And if we can see that really increase with AI, which who knows at this point, if people use it as a tool or
maybe that's not it, it could be something else, right?
Yeah, it could be something else. They could maybe do things, I mean, who knows at this point, but the problem is without those kind of increases, you're not getting increased labor productivity. It peaked. And essentially the growth rate had peaked. Manufacturing is a big one. Look at the US. It's literally been flattened down for over 15 years at this point. And there's other reasons for that, China flooding our market, crowding out our manufacturing, of course. But his argument then is if you're having these peaks, like the college wage premium has been flat since 1999, meaning the premium you used to get above a high school degree was always rising. Well, now it's flat. The only thing that's gone up is getting the cost of the damn degree, which is up like 390%. So the cost of getting it, but the wage premium of getting it over a high school degree isn't as justified anymore. I mean, he goes into like all sorts of data. Labor force participation has been declining since the 90s. But to your point, in the 90s, a big difference then versus now, and that actually led to a lot of productivity growth. And he highlights this was the laying of the fiber optic cables. He said, you know how much demand that took, the labor that took, the investment that took to transition everything. He said, but AI, you're using the same fiber optic cables. You're using the same technology. You're just building on it at this point. The infrastructure was already there. So I guess it would depend on how the plants are used or if they really adopt AI. But I don't know on the wage side, if wages can't keep up, and if there's no productivity increase, we're not going to see wages go higher, nominal wages, I'm sorry, especially if the CPI is falling. If the CPI goes back up, it'll bring nominal wages up. But now, then you have the problem is, okay, inflation's cooling, great. That also means, oh shit, my nominal wages are declining. Oh, but my debt burden went up. My real debt burden, because it's compounding interest. So my nominal wages are declining, but the interest I owe on these things, on the debt I took out, is increasing. And that's usually where the problem comes in. And as we've seen in China today, Japan 1991, Europe 2011, US 2008. So I don't know I'm not saying we're at that point, there's a whole bunch of other factors, but it does worry me historically when private debt gets too high.
Sure. David,
Yeah, so the problem I have with the Gordon book is that basically the real, if you read the book, the unsaid intellectual thread is that we've pretty much invented everything. What else is there to invent? We can get a marginally better car, but it really doesn't add a whole lot of value. And that's kind of the real intellectual crux of his argument, is that we've reached a point of diminishing returns where today's car doesn't really provide that much more utility than last decade's car, and that's correct. But I think you need to dig a little deeper into understanding the real core understanding of productivity itself. And productivity itself really comes down to accelerating things, moving things. The story of productivity goes from whether you're digging a ditch with a shovel and then get a backhoe scooper, whether it's you're lugging things on camelback to train to truck, whether it's the story of productivity is really about moving things. And those things can be physical goods, it can be food, it can be whatever.
information.
I think that's what I was going to get at. So now, what AI is going to do is accelerate that next frontier. That next frontier is, we don't have to worry about moving, oranges or moving whatever. So, the Silk Road from 600 years ago, Marco Polo, whatever. We're now at another plateau. And the tool for that is AI, because what we have to move, the goods and services we have to move now are found in information. And so AI's promise, again, I say promise, hope maybe, but the idea of AI, what it's really going to do is accelerate the movement of information. And here's a good example. The next generation of NVIDIA chips are being invented and designed by its own AI. Their own engineers don't even know what the hell is going into this thing. So the development cycle that would have
Probably pretty safe, right?
Yeah. So the development cycle that would have taken years now takes months.
Yep.
Right. Ditto with medicine, right? FDA approval. In the old days, it took a decade, something crazy to get the next drug out, right? And then they had to do all these FDA trials and blah blah, level 1, level 10, God, whatever. It was just it's like a nightmare, right? AI is going to cut that down to maybe low single digit years or even months, right? Yeah. Once we have enough information, then AI will do its thing. So here's a good example. Google is working on a AI application where you're going to take your, My Charts, that health data record platform. You're going to feed this thing into the AI, and this thing's going to tell you what's going on with your body, right? My late sister, passed of cancer in 2020. When she got sick from leukemia, her symptoms started in late March. She didn't get a diagnosis until late July. Okay, those 4 months could have saved her life. AI will take this, chicken shit. We got to run this test, we got to run that test, and wait and blah blah. No. AI is just you're gonna plug it in, and you're gonna have a diagnosis. You just cut off. I can't hear you. I can't hear you.
Sorry.
Let
me give you kind of a more prosaic example that, it's a little less seemingly exciting, but it is a big productivity ad. And this is kind of a self-promotion, but I'm going to do it anyway. What we do at Complete Intelligence is we automate the annual budgeting and monthly reforecasting process for companies. Okay. Companies have hundreds of people who work on that, hundreds of Excel iterations and so on. And it typically takes them at least 6 weeks to maybe 3 months, right? And so we have a customer, and again, I don't mean to go in a shameless pitch mode. I'm just trying to help you understand how productivity kind of comes out of this, right? We have a customer that took 3 months and 400 people, not full-time, of course, but 400 people off and on, to do their annual budget. They have about $12 billion in annual revenue, okay? 3 months, 400 people. We did it in 72 hours, okay? And we were 0.3% away from what those 400 people took 3 months to do. Not only that, their budget is 3 layers deep within the general ledger. We went 6 layers deep within the GL. So it was the accuracy was actually higher. We were told a year later by the head of FP&A a year later that the accuracy was actually better and much deeper than what their own people took 3 months and 400 people, again, not full time, to do, right? So again, this is a pretty, I would say for most people, a kind of a boring application of artificial intelligence, right? But if you can take, X million dollars of people time and put it into a small monthly recurring, and again, I'm sorry for the shameless plug, but I'm just letting you know how boring kind of AI can be, but how it can add to productivity, right? So
absolutely.
I think that your concerns are well-founded. And David, I think your assertions are in the right place. I think AI, AI has become a preconceived idea, but what's more basic than that is processing power, right? So AI is really directed statistical processing power, whether we want to admit it or not. That's really kind of what it is, right? It's bounded, statistical processing power with different applications, right? And that's what our brain is. Our brain is processing power. It's a very efficient processing power. And so, the kind of worry that, AI is going to take over, it's going to be so productive, it's going to take over jobs. I'm not really worried about that. We always, kind of factor new tech into what we're doing, right?
These things take, think of the time it took for the last, I don't know, the last Pony Express guy to be put out by the train, or the last, the last ice delivery guide to be put out by the freezer. That takes a long, I think it takes time. It takes a lot of time, and typically economies and people adjust over that time frame expectation. In other words, when you're in high school, you're like, all right, that's one job I don't want to do because it's being done by something else. And so by the time you're in the workforce, that transition's already been made. So these things take time. Yeah.
That's right. Exactly. So Adam, I end this segment with a hopeful view that we can take the productivity concerns that you have, and actually over the next few years, we're going to see a lot more productivity out of the workforce. Is it going to happen by 2025? Unlikely. Is it going to happen by 2030? I really do think we'll start to see the impacts of those by 2030.
And just a final note, and I agree. I mean, like I said, I have no idea what'll happen. That would be great. But then we got to contend to the problem is increased productivity then essentially means real wages would rise. The supply of the output would be increasing faster. At the same time, you're having baby boomers across the world, the largest population growth that we've ever seen retiring, which would be deflationary on itself. So would AI then be able to work in a credit-based economic system that depends on asset prices, that depends on new debt being formed? Or is it just can the offsetting of the few getting higher nominal wages offset the deflation from those not working in the labor force? So that's a question that remains.
That's a very big question, and we could
who knows at that point, right?
Hey, good.
Beautiful
guys,
picture.
thank you. And I'm sorry Tracy had to
you.
leave for another discussion. She's very popular. So anyway, guys, thank you so much for taking the time. This has been fantastic. Have a great weekend. Thank you.
Yeah, thanks for having me. It was a pleasure talking with you, David. Very insightful.